Imagine waking up and seeing the headlines everywhere: stock market crashes, massive sell-offs, recession fears, markets bleeding. The panic is everywhere. Your friends are selling their stocks. Social media is flooded with posts about how terrible the market is and how this is the beginning of the end. Even the financial analysts on TV are shouting panic and crisis. It's easy to get caught up in the fear, but here's the thing. I want you to forget everything you think you know about market crashes. Forget the drama, forget the panic, because while everyone is talking about how bad things are, some of the wealthiest people in the world are quietly making their moves. And if you know how to take advantage of this situation, you can actually build wealth when everyone else is panicking. In fact, market crashes are often where fortunes are made. Let me tell you exactly how I'd take advantage of this and build wealth if I were starting from scratch today. No money, no investments, just the desire to get ahead. The first thing I do is calm down. The number one mistake most people make when the market crashes is to panic. When people panic, they make emotional decisions that are based on fear rather than logic. They sell off their investments, they pull out of the market, and they lock in losses. But the truth is, crashes are a natural part of the market. They happen all the time. The market goes up and the market goes down. That's how it works. It's called market volatility, and it's something every investor has to learn to live with. Here's where the opportunity lies. During a market crash, the prices of stocks and other assets drop significantly. This can create opportunities to buy quality investments at a discount. Imagine you're shopping for clothes. The store has a sale and everything is 30% off. If you know that the clothes are good quality and you'll still wear them next year, you'd be silly not to buy them while they're discounted, right? The same thing applies to the stock market during a crash. When the market crashes, there's a discount on assets that are fundamentally strong. The best time to buy is when fear is at its highest and prices are low. I'm not talking about jumping into risky, speculative stocks that are collapsing. I'm talking about buying strong, well-established companies that are temporarily undervalued. So the first thing I do is shift my mindset. Instead of thinking the market's crashing, I'm going to lose everything, I'd start thinking the market's crashing and this is an opportunity to buy assets at a lower price. This mindset shift is crucial because it'll help you avoid the trap of panic selling and set you up for success. Before I even think about investing, I need to have cash flowing in. I need money coming in so I can take advantage of the market's discounts. I wouldn't start by jumping into investments right away. Instead, I'd focus on increasing my income first. There are countless ways to do this, especially with the internet at your fingertips. If I didn't have any skills right now, I'd learn one. There are so many opportunities to make money online, and many of them don't require a lot of experience. I could start by offering services like writing, graphic design, video editing, virtual assistants, or even teaching English online. Websites like Fiverr, Upwork, and Freelancer are perfect for finding gigs. If I have a knack for social media, I could offer social media management or content creation services. The goal is simple. I need to generate cash flow that I can then use to invest. I wouldn't be looking to make a huge amount of money immediately, but if I can bring in an extra $500, $1,000, or $2,000 a month, that's a great start. That money can go toward my investments and my financial goals. The key is to start small and grow from there. Before I start investing, I need to make sure I'm protected. I wouldn't put any money into the market until I have at least $1,000 saved in an emergency fund. This emergency fund is essential because life can be unpredictable. I want to make sure that if something goes wrong, an unexpected medical bill, a car repair, a job loss, I don't have to dip into my investments or go into debt. Building this emergency fund would be my number one priority. I'd save aggressively, cutting out any unnecessary expenses. No eating out, no impulse buys. I'd cancel subscriptions I don't need. I'd find ways to save money wherever I could. The goal would be to get that $1,000 saved as quickly as possible. Once I've got that buffer, I'm ready to move on to the next step. Now that I have some money coming in and an emergency fund in place, I'd start educating myself on investing. The stock market can seem intimidating at first, but the truth is it's not as complicated as it seems. There's a ton of free content available online that can teach you how to invest. I'd start with YouTube, podcasts, and books that explain the basics of the stock market, personal finance, and investing. I'd learn about things like dollar cost averaging, what makes a good company, how to read financial statements, and how to spot a good deal during a market crash. There are a ton of free resources out there, and you don't need a degree in finance to get started. In fact, I'd recommend keeping things simple at first. The goal is to build a solid foundation of knowledge before I start investing real money. The next step is to open a brokerage account. There are plenty of platforms to choose from, but I'd pick a reliable, low-cost one. Websites like Robinhood, Webull, Fidelity, or Vanguard are all great options. I'd choose a platform with no commissions or hidden fees and one that offers easy-to-use tools for beginners. Opening a brokerage account is a pretty straightforward process. I'd go through the steps to set it up, linking it to my bank account, and then I'd be ready to start investing. The key here is to start small. I don't need to dump all my savings into the market. I'd start with $100, $200, or $500. The goal isn't to get rich quickly, it's to build the habit of investing regularly and consistently. Once my brokerage account is set up, I'd begin my investing journey with index funds or ETFs. These funds are an easy, low-cost way to get exposure to a wide variety of stocks, bonds, or other assets. Instead of picking individual stocks, which can be risky, index funds and ETFs allow me to invest in the overall market. I'd focus on low-cost funds like the Vanguard Total Stock Market ETF or the SPDR S&P 500 ETF. These funds track the performance of the stock market as a whole or a specific index like the S&P 500. The idea is to spread my risk across many different stocks rather than putting all my money into one or two companies. Over time, these funds have historically delivered solid returns and they're a great place to start for beginners. The next strategy I'd use is dollar cost averaging. Instead of trying to time the market and pick the perfect moment to buy, I'd invest the same amount of money every month, no matter what the market is doing. This strategy helps reduce the impact of short-term market fluctuations and takes the guesswork out of investing. For example, I'd set up an automatic transfer every week or month to buy $50 or $100 worth of my chosen index funds. Some months, the market might be down and I'll get more shares for my money. Other months, the market might be up and I'll get fewer shares. Over time, this strategy smooths out the volatility and helps me avoid making emotional decisions based on market swings. As I get more comfortable with investing, I'd start building a watch list of individual stocks. I wouldn't just throw money into any random stock, though. I'd focus on quality companies that have strong fundamentals and a good track record of performance. I might look at companies like Apple, Amazon, Microsoft, or Tesla companies that are leaders in their industries and have a solid future. During the market crash, these companies will likely drop in price, but they're fundamentally strong. I'd watch for these dips and look for opportunities to buy when prices are lower than usual. I'd start small, buying a few shares at a time, and gradually build positions in companies I believe in. While I'm focused on building my investments, I'd also focus on increasing my income. The more money I make, the more I can invest. I could start a side hustle, build an online business, or even create content on platforms like YouTube or TikTok. There are so many ways to earn money in today's world, and the more I make, the faster I can build my wealth. The key is to keep scaling. As I earn more, I'd increase my investments. This doesn't mean I need to get rich overnight, but it does mean I need to be proactive about finding opportunities to earn more and put that money to work. The last step is to stay disciplined and ignore the hype. There will always be people telling you what to invest in next, whether it's the next big stock, a cryptocurrency, or a new trend. But the key to long-term success is staying focused on your strategy. Stick with your index funds, continue to dollar cost average, and ignore the noise. If you've done your research and made smart investments, stay the course. If you found this video helpful, make sure to like, comment, and subscribe for more investment tips and financial strategies. And don't forget to hit the notification bell so you never miss an update. Keep investing smartly, stay calm, and I'll see you in the next video.